Picking stocks can be a lot of fun. However, it can be constant work to maintain the portfolio. And the irony of all of this, the more active a portfolio is, the chances are, and the higher chances that it is going to underperform the market. Now, something simpler and far more passive is what I do. It is ETFs. And in today's video, we're going to be looking at 4 specific ETFs in a portfolio to really encompass everything. Now, I talk to my financial advisor. We talk about, exchange traded funds. We talk about building and really holding wealth and how to create it. And overall, there's a couple things in here that I want to share with you, because in the end, if you're ready to make a shift and you want a portfolio that is going to be built of simple ETFs that cover everything, including some of the exposure that I'm missing of my 2 or 3 ETF portfolio. And looking at this, again, there are going to be only 4 ETFs. Now, why only 4? Super easy to manage. You can really set it and forget it depending on the allocation, which we'll go over. Very low fees, and this ETF portfolio is going to have global exposure. Now, traditionally, I do not invest into anything in international markets, and my financial advisor says that is a big miss, that I should have a portion in there. And also looking at the growth potential. When we start looking at the US market, when we look at AI, when you look at quantum computing, there is a lot that we could be missing with portfolios. And that is why I want to start and really break this down. So the first one with the ETFs is, of course, the Vanguard S&P 500. We have always talked, this is the basic, this is the foundation, this mirrors the S&P 500. So you are investing in the 500 largest companies. This is the buy and hold. This is what Warren Buffett talks about. This reflects 80% of the US stock market, which is kind of crazy. Average return just north of 10%, which again is a pretty phenomenal return. Now for this, we could look at the SPY, we could look at the VOO. Me personally, I do invest in the VOO. If you checked out the portfolio, it is super easy. It has an incredible amount of liquidity. Vanguard's version, very cheap to own at a 0.03 expense ratio. And of course, just putting money into this on a regular basis is going to build a really big portfolio. Now with this, very strong returns. S&P 500 again have had very strong returns. And as a core or a foundation to any portfolio, that is where this VOO ETF does come in. So when we start thinking about Apple, Microsoft, Google, Amazon, Nvidia, they are the core, they are the biggest players, they are the biggest holders when it comes to this portfolio. Now the next one, and this one I had to do a little bit of research, which is the XLK, the technology sector ETF. And this, again, is interesting because you have a very heavy tech focus into technology. Again, looking at Apple, Microsoft, Nvidia, this is going to have a little bit of overlap for the VOO, but this is going to be the growth focus. Now, this personally is not one that I own, and I want to show you the little speculation or a little bit more risk, and why in this article from the Monty Fool, they really do talk about it, is this focuses and gives you an oversized stake into technology, meaning it is a lot more of a focus. Now, after this, in 3 decades, technology companies are actually crushing it. So a lot of people say, why not just invest in the QQQ like I do carry in my portfolio? And this had an interesting spin on it, saying that when we start looking at the NASDAQ 100, and this again took a little bit of research, many of the market and many of those technology companies are within the NASDAQ 100, Nvidia, Microsoft, Apple, but this might not always be the case in the NASDAQ 100. NASDAQ isn't inherently a technology and technology-owned index. It just happens that most of the big names within the NASDAQ 100 are tech companies, but it doesn't mean over the next 10, 20, 30 years, we are going to see that exact same growth within the market. As time marches on, new companies could come out, bigger companies could come out, and the new titans of this really NASDAQ could not or might not even be technology companies we could see in the future. This is the reason why when you look at the XLK with the technology select sector ETF, it is focused in technology and only in technology. There is not going to be a deviation. There is not going to be a change. And when I even looked at the performance of this, it was right on par. It lagged that QQQ just a little bit overall in the portfolio, which again, the QQQ has had an amazing run with technology, launched back in 1999, which I do hold in my portfolio, but it has also missed out on some of the smaller tech companies that are picked up within the tech sector specifically. Now, of course, this is the one, and I want your input and I want your feedback down below in the comment section. You need international stocks more than you have in a very long time. This again is where myself and my financial advisor are kind of at ends. Do you really need to own foreign stock? That is what we are talking about. Very prudent question. When we start thinking about foreign stock, the beginning of this year, it did incredibly well, and it has been performing well. And when we start thinking of the growth of the US economy, and this is where I feel like it gets a little bit dicey. Now, for this ETF, we chose the IEFA, the iShares Core MSCI EAFE ETF, which again is an iShare. So this is an ETF that focuses on developing markets. So it is diversification beyond the US border. So it is in those international markets. When you start thinking of the companies, so think of Nestle, Toyota, Samsung, a lot of the names that you might not realize are not US based, are not US companies, and having exposure to some of the foreign markets. Like we said with the economy, they are thinking the worldwide GDP is going to grow 2.9% this year and possibly 2.9 to 3.2% next year. United States GDP is expected to grow 1.6 to 1.4 next year, which again, with the global economy starting to pick up a little bit more. And they also note that the pro-intra-trade policies really a lot more focus on domestic trade, keeping it a lot more local within, Europe, Japan, Australia, even China, keeping a lot more of the trade local due to tariffs. When you're exporting, it really shows the GDP in these developing countries or in some of these larger markets are going to have a lot more growth than we could experience within the US markets. So having a small exposure in there could really make a big difference when it comes to building this out. The foreign stocks have easily outperformed US stocks so far this year because of the fear and really the consideration of tariffs. So even though you might have a little bit of exposure, like, 10, maybe 20% into the non-US markets or into those foreign markets, it might really make a big difference. And one that I was not aware of because most of my portfolio focuses on the larger cap is the VOO, which is the Vanguard Mid Cap ETF. This is focusing not on those mega techs, those $1 billion, those $1 trillion companies. This is looking at mid-sized companies within the United States that really have a very high growth potential, overlooked but critical for diversification, because you're not just focusing on those 500 largest, you're also looking at the mid cap. The mid cap catches the next big thing. So when we start thinking of the performance of this specific ETF, it has almost doubled what the S&P 500 has performed in the last 25 years. Now, this was very interesting. The S&P 500 in the last 25 years has returned a 326% return, which is kind of crazy when we think of the growth. When we start thinking of the Vanguard Mid-Cap ETF, that VO, it has yielded a 615% return over that exact same 25 year timeline, which is kind of crazy. So when we start thinking mid-cap, Shopify, Dexcom, Moderna, there are a lot of companies that are not into the large cap yet. And even thinking in my kind of allocation or my thought behind this is if you start looking at some of those mid-cap companies, you could capture a lot of those AI companies that are up and coming, a lot of those companies that are quantum computing, a lot of the companies that are healthcare revolutionizing, really heavy tech startups. You could capture a lot of those with a mid-cap ETF instead of just saying into those larger ETFs. So what exactly would your allocation look like? So the sample allocation for this is putting 40% in that VOO, which is going to be the foundation, which is really going to be the fundamental, putting 20% in the XLK, which of course is going to focus heavy into that tech sector. International, the IEFA is going to get 20% as well, and that VO is going to get 20%. Now, of course, this is going to be based, and this is going to change, and it will change based on age. That is one of the most important things where if you want more growth, you could boost up what you're putting into the tech side. You could put more of what you want into that mid-cap side to really look at a lot more growth in this portfolio. You may take that 20%, put it to 25, even put it to 30, depending how risky you want to get to it. If you're a little more risk diverse, or if you're looking for stability in the portfolio, putting a little bit more into like the VOO or putting it into international would make a big difference. Now, I was looking at some of your target date funds. Now, of course, most portfolios, most 401k plans do offer target date funds. And interesting enough, with the target date funds, they had roughly 40% in international markets, which was kind of crazy. So we were looking, and I believe it was a 2060 Vanguard target date fund. There was about, I think it was 37, 36% that was allocated into foreign markets, and roughly 50%, which was allocated into the US markets. So it was almost the entirety. And I think they had like 6%, 5 or 6% that was just a little shot into domestic bonds and foreign bonds, but the rest of it was either large cap, which we see, and it was like a VTI. It was a total index within the US markets of roughly, I think it was 47%. And then the other 40%, almost 40%, was the international markets. And that was what it encompassed in its entirety when it came to that international and really those target date funds. So that is it, guys. 4 very simple ETFs, 1 very powerful portfolio that you could build. Global diversification has a heavy tech focus, very simple to maintain, very, very low cost average. So if you like the portfolio, let me know in the comments. Smash that like button, subscribe to the channel, comment down below. What is your favorite ETF right now, or what company are you investing in? And I'll catch you in the next video.